All right, let's dive right into this explainer covering Nestle India's absolutely spectacular Q1 FY27 financial performance. If you follow the fast-moving consumer goods or FMCG sector, you know it's been a pretty tough environment lately. Companies are grappling with wildly fluctuating commodity costs and constantly shifting consumer habits, but Nestle India? Well, they just reported one of their absolute strongest quarterly performances in recent memory. So today, we're going to break down exactly how they pulled this off, where all this massive growth is coming from, and of course, what risks might be lurking just around the corner.
Now, you might be wondering what the biggest takeaway is, and it's this massive revenue growth figure right here, 25.16%. In a climate where so many competitors are frankly struggling just to maintain pricing power and are limping along with low single-digit growth, Nestle completely blew past expectations. They pushed their revenue to a staggering 6,378 crore rupees. And what's absolutely crucial for us to understand here is that this growth was largely volume-driven. That means they're actually selling more physical products, not just jacking up the prices on the consumer.
But wait, it actually gets crazier. Their consolidated net profit surged by 48.26%. That is nearly a 50% jump year over year. When a mature, large-cap FMCG company grows its bottom line by nearly half in a single quarter, yeah, that sends shockwaves through the market. It really sets the stage for what is undoubtedly a historic quarter for them.
To really put this into perspective, let's look at the absolute numbers. We're talking about revenue blowing past that 6,378 crore mark, which is up from just under 5,100 crore last year. And that net profit? It's nearing the 1,000 crore mark, landing at almost 959 crore rupees. These are not just tiny incremental gains. This is a massive structural step up in their baseline performance.
So, here is our roadmap for today. First, the Q1 earnings blowout. Second, decoding the growth engines. Third, the quick commerce revolution. Fourth, Nestle versus Hindustan Unilever. And fifth, future outlook and risks.
Let's get started with Section 1, the Q1 earnings blowout, profitability and margins.
This perfectly illustrates what we call operational leverage, and it has a cascading effect. Revenue grew a very healthy 25%, sure, but EBITDA, which gives us a clear look at core operational profit, outpaced it at nearly 40%. And then net profit grew even faster at over 48%. This tells an incredibly compelling story. They are getting significantly more efficient as they scale. Basically, every new rupee of revenue is translating into proportionately more profit.
And that brings us to their profit margins. Despite a really complex and difficult commodity environment, which we'll definitely get into a bit later, their EBITDA margins expanded by 253 basis points. That's just over 2.5%, allowing them to hit an incredibly robust 24.12%. So how did they do it? Mostly through a much better product mix, meaning they're successfully selling more of their higher margin items, along with some really smart manufacturing and cost-saving initiatives.
Moving right along to Section 2, decoding the growth engines. What exactly drove this massive surge?
What's amazing here is that this success wasn't just from one lucky product. It was incredibly broad-based. Domestic sales jumped 25% as they successfully pushed deeper into rural markets. Exports, up a massive 35.6%, completely defying global geopolitical friction. But a true standout for sure is the beverages segment. Nescafé has now locked in its 20th consecutive quarter of double-digit growth. Let that sink in. That is 5 solid years of relentless expansion. Meanwhile, KitKat is grabbing serious market share in the confectionery space, helped out by really clever cultural partnerships, like their One Piece anime collaboration.
Now you might be thinking, hey, did they just slash their marketing budget to boost those fat margins? Actually, scratch that. It's the exact opposite. This quote from Chairman and MD Manish Tiwari shows us that they aggressively bought this growth. They boosted advertising expenditure by more than 40%. They leaned heavily into brand awareness and digital campaigns, and because the resulting sales growth was so explosive, it completely offset the higher ad spend. Honestly, that is a masterclass in capital allocation.
Okay, Section 3, the quick commerce revolution, the new distribution ecosystem.
To truly understand Nestle's digital success, we have to look at the battleground of their delivery partners. Quick commerce in India has evolved from a luxury straight into an everyday habit. Zomato's Blinkit currently dominates with a 46% market share and is incredibly close to breaking even on EBITDA. Swiggy's Instamart holds about 25% but is burning quite a bit more cash. For Nestlé, this rapidly growing 10-minute delivery infrastructure represents a massive new distribution channel, and they're definitely not treating it like a traditional grocery store.
Instead, Nestle has developed a highly specific quick commerce playbook. By tailoring their offerings with platform-specific pack sizes, because let's face it, what you order for a 10-minute delivery is way different from a monthly supermarket haul, they are perfectly positioned to ride this wave. They are launching exclusive products on these digital platforms and making absolute sure their Maggi noodles and KitKats are always stocked in those local dark stores, right when the consumer gets a sudden craving.
Let's move to Section 4, Nestle versus Hindustan Unilever, a tale of two strategies.
Comparing these two beasts side by side really puts things in context. HUL is India's largest FMCG company, holding about 23% market share with a massive diversified portfolio. But look closely at the growth numbers. HUL is seeing low single-digit volume growth and revenue growth sitting between 2 and 6%. Nestle, on the other hand, is delivering explosive, high double-digit volume growth. And while HUL offers defensive stability and a solid 2% dividend yield, Nestle's dividend is lower simply because they are aggressively reinvesting their cash right back into this hyper-growth engine.
So the crucial takeaway here is understanding exactly what kind of strategy you're looking at. HUL pays out a massive 92 to 97% of its profits as dividends. It's safe, it's diversified across home and beauty, and it's built for steady, compounding income. Nestle has a much narrower focus, literally just foods and beverages, but they generate a staggering return on equity of around 66.5%. That means they are highly efficient at generating profits from capital. It's a higher risk, highly aggressive growth play.
Which brings us to our final section, Section 5, Future Outlook and Risks, Navigating Headwinds.
Because we have to ask ourselves actively, with raw material costs fluctuating so wildly across the globe right now, can Nestle possibly maintain these beautifully expanding margins we just spent the last few minutes looking at?
See, because Nestle is so hyper-focused on food and beverages, they lack the broad safety net of a company like HUL. That means they are highly exposed to the severe inflation currently hitting global commodity markets. We're talking about surging cocoa prices, incredibly volatile coffee bean costs, and rising expenses for milk and dairy proteins. If these raw material prices stay elevated, or if rural consumer spending suddenly hits a wall, Nestle's heavy reliance on just a few core brands like Maggi, KitKat, and Nescafé could suddenly shift from a major strength into a real vulnerability.
And that brings us to the ultimate question for anyone analyzing this space. The market absolutely loved these Q1 results. The stock reacted beautifully, touching intraday highs of 1,510 rupees. But I'll leave you with this provocative thought. Considering the massive leap in Q1 profits we've mapped out today, weighed against the very real and immediate threats of cocoa and coffee inflation, is Nestle's premium stock valuation truly justified for the long term? Or are we possibly looking at a peak earnings cycle? It's a question every focused observer needs to carefully consider.